Welcome to the daily update. This is being prepared Wednesday, June 22nd, where we'll look at the action in the market today and then see how things look for Thursday, June 23rd. And it wasn't a real positive day, at least on the surface. And it wasn't a real negative day either, but we might be seeing some potentially positive things under the surface that might help the market go higher. But we need to see this continue. It can't just be a phenomenon that comes and goes. We want to see some follow through that eventually leads to price follow through as well. Before I get going, please know that the video is posted about membership. It's a free membership. I'll have that video up on my YouTube channel and Rumble until June 30th. Then I'll take that down. And it's free to join if you're interested in that, but please feel free to watch that video. I explain more of the different things that I offer beyond just the videos that you watch now. There will not be a daily video tomorrow for Friday. So just know that after this video, I won't prepare another daily video until Monday. I'll still do the weekly video and I'll still do the intermarket analysis video, but that'll be over the weekend. I mentioned this yesterday. A helpful newsletter is Dan Byrd. Here's his email address. I don't have any of his charts today. I did use some in yesterday's video, but he has some interesting insight that you might find interesting. And I'm getting this email too, and it's free. So it just gives you some more information that if I'm talking about this, you might be able to offer some feedback, or it might help you to understand things a little better, or have an aha moment as you're following the markets. Also, Tom Bowley from stockcharts.com. He also is from another website called earningsbeat.com. He has some videos that he posts on YouTube that can be insightful. So I just wanted to make them aware to you of them. Yes, this is another take one video, and you might be hearing some construction noise in the background. But let's go back and talk about Wednesday. At the open, it looked like, oh boy, here we go. The futures were negative and down, kind of strong negative, but they started to recover a little bit before the open, but we still gapped lower. We went down to S1 right at the open, 37.27. It's like, okay, here we go. We had a good day yesterday. Now today, things are going to kind of go crazy again, and we're going to resume this downtrend. At least that's what the mindset is right now of the market. We're also seeing some other things inside the market, but we were able to rebound and get back above the daily pivot at 37.53. It was slightly negative. So then above that, we went above the unchanged line, and then we're able to get positive all the way up to R1, which was at 37.91. So that was a pretty respectable bounce that we saw after the open. As the day went on, prices did fall back, and it's like, okay, here we go. Now the selling's going to start. And we actually went slightly negative, but we're able to rebound from that and get back to R1 and even go above R1. Unfortunately, there was some late day selling that took prices back negative. So by the time we were finished, we were down 0.13%. on below average volume. Our technicals are still negative. We still have a few oversold readings that we're dealing with. We're seeing some improvement, but really nothing has turned positive yet. The markets, of course, are fixated on inflation and interest rates and growth concerns, all the different geopolitical concerns, which could come to the forefront at any time, earnings as they are released, and then also in gold, I have recession fears. You have some people that are ultimately convinced that we are in a recession, possibly even now, or we're going to be in a recession. You have other people that aren't quite so sure about that. If we do end up going into a recession, some of the positive things that we're looking at, that might change, because that means the earnings per share and some of the outlooks and forecasting that is used in the markets, that might be modified, and that could kind of change some of the things that we're looking at. So just be aware of that. Some things that we can take away. Are we forming a bottom here? We could be. There's a case to be made for that, and I'll show you that as I go through the charts. Stocks and interest rates decline together. And then the 10 to the 5 yield curve is still inverted. Fear is still extreme. We had the MBA weekly mortgage application. It came out and actually showed an increase. We've been seeing a series of decreases lately, but it was up 4.2%. Our trend is negative with the ADX going, it's getting a little bit weaker, but it's still in a positive, I shouldn't say positive, it's still in a stronger trend that is negative. And I'll show you the chart. I'm still keeping the bias at negative to mixed until we see a little bit more follow through with price. We have to kind of go with what's been happening. And then the momentum also remains negative over the last few days. Let's go back and see here that sentiment is still extreme. We bounced up a little bit, but we're still in that extreme fear category according to this chart. And here's one of my lovely circles showing that we're pretty far down right now. The VIX did decline overall, even though we had a down day. But remember, a lot of that weakness came in at the end of the day. But we're seeing the VIX really decline both on the bar chart and on the line chart. The VIX of the VIX is also showing a decline right now in fear. We're down 21.97%, so you could round it up to 22% from the all-time high. The equity put call ratio bounced up a little bit because of the weakness that we saw throughout the day. And then our 5-period moving average is actually going down a little bit. And I switched the next chart over into the possible positive scenarios. This is a chart that Dan Byrd had, so I guess I do have one of his today. This just shows you the economic cycle and the market cycle and how they overlap. And it's his belief that we are right here now, where we're at the late part of a bear market. What we've been seeing in 2022, that he thinks that could be coming to an end, and that's usually when the market bottoms. We might be going into a recession, but usually after that is when the market will turn up sometimes. Now, this is just a model, so it doesn't mean that things always play out this way, but this just gives us some kind of a backdrop to work from. We had the Investors Intelligence survey come out, and it shows that we are pretty negative. We're way under 1 as of June 21st, the pretty strong negative ratio, and that could be extreme negative. So that lines up with the fear and greed index that we use. Here's another model that you might find interesting. This just is taking out a scenario and saying, okay, here we are through 2022. This is where we've come. And it kind of looks like something that we saw in 1982 and in 1974. Well, are we going to break off and go like 1982 did and bounce up from here and then ultimately go higher into 1983 like what happened? Or are we going to be like, this is 1973, which was a pretty bad time for the markets, come down and continue to go even further, start off then into 1974, and then see a lot more decline before we see a recovery after that, and then eventually get back into 1975. Things rarely play out exactly the same, but there are a lot of folks that do use this type of analysis. They try to look for patterns in the past and say, okay, when we have what we have right now, when did that happen before? And then what happened after that? And there's some truth to be said to using that. I'm not a big believer in that, but I still like to keep it in part of the overall process anyway. Looking at the global central bank rate cuts versus hikes, going back to 2020, well, that's when the whole world was locked down. So the banks were cutting things, and there was only 6 that raised rates. Then in 2021, we had 13 that cut, where 101 central banks throughout the world raised interest rates. And so far in 2022, we've had 4 that have cut and 124 that have raised rates. So this is more of a global phenomenon that we're seeing. This is another index that I showed a while ago, and it's the truck tonnage index. These are trucks that people buy. And that's the orange line here. And it really declined, but it's starting to show a little bit of improvement. And it tends to track the S&P 500 here. Well, they got way out of line. And so if this is coming up and the S&P has been coming down, are these two going to get closer to each other? And if this orange line continues to go up, that might suggest that the market could go up, and the inverse of that is true. The S&P might have to come down more to meet up with this line as well. It's just another thing to look at. There's people that use the stars and who won the Super Bowl and the phases of the moon. And I mean, if it moves around, if something is out there, people have tried to use it to forecast the market. Also, looking at the 2-year, 10-year yield, that's the dark blue line here. And that's what we've been seeing dancing all around. And then we also have the dollar index inverted. So it's upside down. And it just shows how these two tend to, when this is inverted, they tend to move in the same direction, which means if this was a normal chart, the dollar and the yield would be going in opposite directions from each other. Another sentiment index that we look at about once a week takes a lot of these different things and puts them together into one reading. And we're more in the neutral category, but leaning over towards the fear level of things. Then the Fed funds target rate, this is just what they're forecasting that it might be, that eventually will get up over 4% as we go through 2022, 2023, and then eventually into 2024, they might start to lower interest rates. But it's purely a guess at this point. Also, the risky, meaning stocks, versus safe asset fund flows, it still shows, according to this chart, that people are favoring the safer assets. When we go above this line, that means the more risky assets like stocks. When we're below this, that means bonds, money markets, really very safe investments. Also looking at the core PCI, this is another way to gauge inflation. And according to Bank of America, it says we think PCE inflation will drop to about 3%. Well, remember, we're at 8.6 right now. And if you look at it in real terms, we're at like 17 or something. But according to this, they think that we'll get down to 3% and then stay at about that level. Again, they could be right, they could be wrong, but this is what they are forecasting. Support and resistance. Here's the intraday daily pivot points. I actually labeled this to make it a little easier. And I hope you find this useful. And you might want to pause this and make note of some of these numbers over here on the side. Hopefully that will be helpful to you. Here's the daily chart showing some different pivot levels. We're still below S1. We're still above S2 as the market tries to figure out what it's going to do. And this previous low, that could also act as resistance. We have S1 above us. That could be resistance as well. Then we have, I call this the machine gun chart because there's just these dots all over the place. It just shows where we're below this longer term support, but still above other support, as well as some Fibonacci levels. And down here, you can see where volume really dropped off. We were below average. Here's another, it's the same chart, but it's trying to take some of that mess away, just showing how we're trying to come back up to this level, and that may act as overhead resistance. Also, just looking at the pivot points on a daily chart, and again, these stay the same for the whole month of June. They don't adjust until July. So this might be some other levels that you find helpful. The short-term Fib levels, this is where I measured from the high that we had in late March to the low in May. We dropped below that. We retraced it completely and then some. Well, now if we're coming back up, the 3806 level might be acting as resistance. We're back above this other Fib level, going back to a low that we set in 2021, where we've been able to break above that. We've been above it for 2 days now, so it potentially could act as support if we fall. There's another look showing that we do have some overhead resistance. That's all these different colored lines right here. So be aware of that, but we also have some more support down around 35.14, but that's kind of a long ways away from where we're at right now. The weekly chart, we're trying to get back above this 38.2% retracement, and that's at about 38.05 or 38.06 roughly. If we can get back above that, that would be a good step in the right direction. And then this is the chart showing that same fib retracement from the COVID low to the all-time high, and how the 200-week moving average is coming right up to that same level. So this is kind of like a double layer of support. If we come down to this level, that might help us bounce up off of that. If we come down and break through it, that might mean things are really bad. When we break through pretty long-term major support and keep going, that could bode not so well for the markets. Looking at the sectors, we had a down day, so I organized them according to what was down the most. Energy got hit again, and we're potentially seeing some rotation out of energy. It had done really well for 2022 and was the #1 sector. In fact, I can show you that right here. It's the sector that's been positive, but people are starting to pick up on that now. The people that aren't the institutions that kind of react to what's happening. And so they're starting to jump into energy, and they tend to be late to the party. So it wouldn't be surprising that they're getting in just as about time for things to get done at that point. But we don't know. Things could turn back around and go back up in energy. This is just something to think of right now. We did have a few of the sectors that were up. The one that was the strongest was real estate. It might have bounced a little bit because of the mortgage application reading that we had, because it had been going negative for quite a while. And then I showed you this before. Technical alerts, not very many. Started off negative with the gap lower. Canada started off rough, and the NASDAQ started off rough, but then the NASDAQ got above 11.1 and then 11.2, when the S&P was able to get back above 3,800. The intraday chart, this is kind of the opening. I try to do a screenshot of the overnight futures right when the market opens, but I'm kind of busy right about that time. So sometimes I'm a little late with taking the screenshot, but this just shows how the futures were down pretty significantly. Well, then we started to show a little bit of a recovery. And then by the time things opened for the session, we were showing an actual uptrend. Here's our daily chart showing the gap lower. We were able to get back above the pivot, which was still negative, get all the way up to R1, came back down, went slightly negative again, went back up to R1, broke above that, and notice how 3,800 was the resistance. They like the round numbers. Not only does the financial media like that, but investors like that, because you talk that way. You don't say, oh, I'm hoping for 3962.63. You don't do that. You round it up or round it down. Well, a lot of the algorithmic trading programs, they're also cued in to work with round numbers. Then as the day got closer to the end, we saw some selling come in, and we closed just slightly negative on the day, but still above the daily pivot. Looking at the trend, our ADX is rolling over a little bit, but we're still on top of the moving average, and we can see how selling pressure has started to decrease. We're seeing a bit of increase with buying power. I haven't shown this chart for a few days, the Arun, because it just didn't make any sense, and it still might not, but we're seeing a little bit of a decrease in selling. That's the red line. When it's pegged to the top, that means sellers are in control. Other times when the green line is at the top, that means buyers are in control. Well, we're seeing a decrease here still in buyers, also a little bit of a decrease in sellers. When you take the two together, our oscillator has pretty much gone sideways, but we're still below zero. So it's negative overall. Looking at breadth, seeing a little bit more of an improvement, but we had some damage that was done here. We had a bullish divergence that pretty much went unheeded, and now we've dropped below that. But we saw a little bit of an advance based on price and volume. Our advanced decline ratio is still negative, but showing a little bit of improvement. New highs, new lows, they continue to be negative. 10-day average of the new highs and new lows. We're getting down to an extreme negative reading. That's similar to this. This is a 10-day moving average here. So we're getting down. We could drop a little bit below that, but other times this has been often the mark of some kind of a bottom in the market. Accumulation distribution, still negative, but might be showing a little improvement, but we're still underneath a declining moving average. Short term, the force index bounced up, actually came down just a little bit. Rate of change 10 period, we're still extreme negative there. The Swindlin trading oscillator, this has been kind of hanging in there. It started to show some positive signs late last week, and it's still going up based on price and volume. McClellan oscillator actually bumped up a little bit, but it's still negative because it's below zero. We're coming out of an extreme negative reading with the 20. We're turning up with the 50 as well as the 200. So see, under the surface, we're seeing some improvement happening here. Stochastics coming out of an extreme negative reading, intermediate term trying to, and we're trying to turn up with the longer term stochastics. Intermediate term, the PMO, it's negative, but we want to watch the price and volume indications because sometimes they cross a day or two before the PMO actually crosses. We're seeing a bit of an improvement with those percent of PMOs that are rising, as well as the buy signals, and we're still pretty much flat with the PMOs that are above zero. We're still pretty far away from the mean price, but we're starting to come back down. When we look at the standard deviation chart, the Sean trend meter still is extreme negative. Chaikin oscillator turning up and giving us some positive indications. Chaikin money flows just kind of bouncing around above and below, positive and negative. Still seeing a decline with our volume intensity because we saw just a huge spike last Friday due to quadruple witching. Well, so far this week, we've been below average with our volume. The boom indicator, and actually I didn't show this yesterday, it got deleted when I was messing around with things. But when we measure how far we are away from the 50 period moving average, we're starting to show a little bit of a bounce after being extreme negative, and we're getting down kind of far with the 200. So this could be a longer term indication that we might be oversold and possibly bounce. Vortex, a little bit of a decrease in selling, a little bit of an increase with buying. Summation index continues to fall based on price and volume. All of our momentum oscillators continue to be negative. The BPI, after giving us a pretty extreme negative reading, bounced slightly. Ultimate oscillators actually turned up. The rate of change 50 is still extreme negative, but trying to show a little bit of improvement, even though it was flat. Money flow index turned up slightly. Balance of power, after giving us an extreme negative reading, is trying to bounce up. Ease of movement, also showing some improvement on the 14 calculation. The TTM squeeze, that is still negative. The red lines are increasing as we go down with that indicator. Heikin Ashi, we have 2 open candles now. That's a little more positive. The Kegi is still negative. The point and figure drew in 3 X's on here. There's no signal right now that's being generated, but just the green X's are a little bit more positive. Renko continues to be negative. And if you recall in yesterday's video, these boxes were all red. Well, with the little shift that we saw, it redrew in an open box a few boxes back. 3-line break, though, is still negative overall. Elder Impulse, we are still neutral with the SPX and the SPY. SAR continues to be negative. The go, no go system is still deep purple. Long-term charts, trying to bounce from giving some really extreme negative readings with the 50, 150, and 200. The rate of change going back 200 periods, see how we're coming down to this level? This is about where we got to during the COVID plunge. Going back 250 periods, even longer, we still might have some more room to fall, but this is starting to give us a pretty extreme reading. And here's a really long version of this chart going back to 1990. Special K continues to be down. Broad market, the diamonds are neutral and the Qs are still neutral. Stocks above their 50-period moving average were starting to get extreme negative with the S&P. And here's the mid caps, also extreme negative, but this is interesting. We've actually bounced up a little bit when we look at the small caps. We like to see leadership in the small caps. Sometimes it's not showing up on the chart that we usually look at, but we can see it right here where we're seeing a little bounce up before the S&P bounces up. Now, sometimes that can be a false signal, but we just want to be aware of it anyway. Broad market, haven't shown this in a while. The Crb Index, it was down, but it's still in an overall uptrend. And I didn't put a label on here. I apologize for that. This is copper. When copper's going up, that shows that the economy is getting better. And it's been floundering around for much of 2021 into 2022. Well, we're starting to see it really decline. So that might suggest economic weakness. It tends to be a leading indicator of the economy. The dollar was down about 0.25%, but still in an overall uptrend. And I meant to put this in a different place. This also showed that copper has really been coming down after going sideways. It actually broke below support, according to this. The S&P to the dollar, they're kind of going in the same direction now. That's one of the things that gave me a little bit of hope when I was watching the futures during the night. Yeah, the futures were negative, but the dollar was negative too. So that seemed to have added a little bit of support to stocks. Oil was down. We're at 106.19, still very high, but at least it declined. And the correlation is not really there right now. It almost shows them going in the same direction more than they're likely to go in the opposite direction. Gold is really not doing very much. It was virtually unchanged with the futures contract, up 0.4% with the ETF. Silver is still having some trouble going down. Actually, it's not having trouble going down. It's just going down without any trouble. It was down over 1%. And here's the long-term chart. Looking at bonds, corporate bonds bounced up slightly. The bond ETF was up 0.82. This takes all the different maturities based on price and puts them into an ETF. And we're bouncing up a little bit, and see how we're coming down to these COVID areas here with the World Bond Index. The correlation between the S&P and the 10-year yield is still pretty strongly inversely related. So we want to keep an eye on what's happening with interest rates and what is the S&P doing. Well, are they moving in the same direction or in opposite directions? Tech to 10 also has a pretty strong inverse relationship still. There's only one yield curve that's inverted. So here's the chart of that, the 10 to the 5, which it's been misbehaving now for a number of days. We're coming back down on the 10-year yield. We actually broke back down what was support, and we're coming down a bit with the 10-year yield. There's another look at that as well, where we're breaking below this red line. The 30-year, it's coming back down, but we still have the 50% retracement down below current yield levels. This just shows how interest rates fell pretty much across the board. Are positive, I can't say that. Possible positive scenarios. I want to say positive, but never mind. Here's where we have the equity put call ratio on a longer view, where we had spiked up above 0.8 and now we're starting to come back down. This red area is where we're at currently. And sometimes when we see a spike, that has marked a pretty significant bottom in the market. The percent of stocks above their 200-day simple moving average, we're not necessarily getting extreme. And it's probably really hard to see, but this is one indicator that's used to measure this. And you'll look over here and we see kind of the same thing, but this is a different indicator, but it's measuring the same thing. Not quite extreme, but it is extreme. So it doesn't necessarily have to go down all the way to this level, but it still could have further to drop. Here's the part that's looking more positive, where I pointed out yesterday in late December, we saw the S&P going higher, but we saw a negative divergence with the Qs, discretionary and growth to value ratios. Well, here we're seeing lower lows in the S&P and we're seeing a positive divergence right now. And that just means there could be some rotation going on from the value oriented side of things back into the growth side of things. And that's what Dan Byrd and Tom Mowley are pointing out. And here's another chart to show you the same thing, where we saw a negative divergence late in 2021. We're seeing a positive divergence right now. So we just want to see how this plays out. Here's our trend channel. We're coming right back down to the midpoint, and we bounced up off of that slightly. Can this act as support? The spike, well, after coming up, now it's come back down a little bit, but we don't really know if this is spiked for a good solid spike or not yet. And the correlation, it's still pretty inverse, but starting to wear off slightly. The staples, we're down also, and this is still holding up right now. It's kind of like a double or a head and shoulders top here, where we have a left shoulder, the head, and then the right shoulder. But I wouldn't read too much into that. Some people might, but I don't. Where we're still working off of this spike, but we want to see follow through based on price. And that's just not happening yet. So what's our outlook then for Thursday? We're still negative as far as the technicals. We still could be bouncing from an oversold condition. A lot of people are using that as justification. There are some possible positive setups that we just went through. Sentiment is still very negative. On Thursday, we have the first quarter current account balance, not a real big one. Jobless claims, unless it's really out of line, that usually isn't that much of an influence. And the preliminary June IHS market manufacturing and services PMIs. Want to keep an eye on those. And then Fed Chair Powell will continue with day number 2. He testified before the Senate today, and then he'll testify before the House tomorrow. It's what he does 2 times a year. And then we have all of the geopolitical events, Russia, Ukraine, the supply chain issues, and what's going on in China with some of the lockdowns still happening and heavy testing for COVID, inflation and interest rates and growth concerns. If we start to fall, there might be more of a concern for margin calls. Oil, it's been kind of declining lately. Earnings as they're released, what Chairman Powell may say today, it'll probably be in the Q&A section if anything strange happens, because he'll usually just read the same thing at the beginning that he read yesterday. So it's not necessarily anything new. The longer term situation with Japan that I'm keeping an eye on, and then of course the recession fears. So what's our scenario? What could keep us going down? All the things I just talked about, and the technicals are still negative. And right now it looks like they're bouncing from oversold, even though we're seeing some positive things. We want to see follow through with price, and that hasn't happened yet. Going up from here, we are bouncing because we're oversold. A real disbelief that the market's not ever going to go up ever again. And these possible positive setups and these scenarios, are we seeing sector rotation going back into growth? That's what those charts are showing us might be happening. We have the technicals that we look at, the pivots, Fib retracements, and then previous levels. If we're going down, they may act as support. If we're going up, they may act as resistance. We are not neutral right now with the ADX above 20, and it's negative. So our conclusion then is the S&P is negative, but possibly rotating back to growth. Short-term negative and bouncing, intermediate term negative and possibly bouncing, long-term still negative. So thank you. Have a very good Thursday, and I will look forward to preparing the next video for Monday's session and then the videos for the weekend as well.